Hello and welcome everyone. Today, we dive into a really exciting topic that has been on the top of the minds of many of our clients, which is navigating the complex cost and price dynamics in global ITBP delivery amidst today's volatile landscape. With mounting cost and margin pressures across geographies, industries, and functions, outsourcing deals are now being reshaped in ways that demand strategic insights. We'll explore how to effectively manage these challenges and stay ahead in a constantly shifting environment. Our session will focus on three crucial areas. First, we'll take a look at the market trends, both historically and what we can expect for 2024. We'll discuss the current levels of activity, focusing on both service providers who have seen recent shift in demand and GCCs or global capability centers or global in-house centers, which have been gaining traction recently. Next, we'll dive deeper into pricing trends where we'll examine how costs have evolved, the underlying factors driving these changes, and most importantly, how they impact both existing and new commercial deals in the market. Finally, we'll discuss the actionable levers that both GCCs and service providers can pull to optimize costs. We'll provide specific recommendations for service providers on how they can win more deals while optimizing their margins in this evolving landscape. Now, starting with the first piece around the current market pulse. Over the past few years, we have witnessed significant shifts in this space. After the pandemic, 2021 and 2022 saw a strong rebound for both GCCs and service providers. Revenue and headcount growth both surged to double digits, reflecting the high demand and expansion during that time, which was a huge step up if we compare it to the 5 to 7% annual growth in the pre-pandemic years. However, 2023 has been a different story. Several key factors have contributed to a slowdown in growth, which include macroeconomic disruptions around the globe, fiscal tightening in multiple regions, rising geopolitical tensions, and supply chain disruptions, which have driven up costs and placed an increasing pressure on margins. As a result, growth rates in 2023 have dropped to low single digits. Earlier this year, there was an optimism and anticipations for partial recovery in 2024. However, as we stand in the third quarter of 2024, it's becoming clearer that growth is likely to remain subdued and margin pressures are expected to continue. Now, based on these trends and current market sentiment, we estimate that the overall revenue growth in 2024 will be limited to 2 to 4%, which is a marginal deceleration from 2023. This would bring total industry revenue just below the 300 billion mark. We also project a 2% growth in headcount, resulting in around 11 million full-time employees in the industry by the end of this year. Now let's take a closer look at headcount growth projections across different markets. The overall sentiment across the leaders among enterprises and service providers is that the strongest growth in headcount is anticipated to occur in offshore markets, with a projected increase of nearly 6%. This growth is driven by multiple factors, including lower operational costs in offshore locations, coupled with high scalability potential, leading to an overall strong talent value proposition. Making these markets highly attractive for expansion, and following offshore markets, we expect nearshore geographies like nearshore Europe and Latin Americas to experience a 2.7% growth in headcount. These regions provide a balance between proximity and cost efficiency, which continues to make them appealing for organizations. What's particularly noteworthy is the onshore market, where the headcount growth is expected to be a mere 0.1%. This is largely due to cost pressures in onshore markets, as well as a focus on optimizing delivery pyramids across various functions, with a strategic shift towards leveraging more offshore and nearshore centers across industries. Now, the illustration on the left reflects the overall market sentiment. The chart on the right provides actual data on the new center setups in offshore geographies split by regions. Across both enterprises and service providers, there has been roughly 200 new center setups established in offshore and nearshore locations so far in 2024. The expectation is for this number to surpass the 400 mark by the end of this year, potentially matching the 2023 figures by falling slightly short, much like the trends in revenue and headcount growth. The Asia-Pacific region continues to dominate the global services market, And it has exceeded enterprise expectations, with its share of delivery centers growing from 46% in 2020 to a substantial 65% in the first half of 2024. Leading this change is India, which accounts for more than 70% of the new center setups. Beyond these traditional hubs, we are seeing growth in smaller Southeast Asian markets like Malaysia, Indonesia, Vietnam, and Thailand. With these locations offer skilled talent and diverse talent with strong multilingual capabilities and less market saturation, making them attractive for companies. And even within India, growth is not just limited to tier 1 cities like Bangalore, Delhi, NCR, or Hyderabad. We're also seeing significant expansion into tier 2 and tier 3 cities such as Ahmedabad, Coimbatore, and Jaipur. Both service providers and enterprises are drawn to these cities for their untapped talent pools and marginally lower operating costs. Now, in contrast, nearshore Europe has seen a decrease in its share, dropping from 26% in 2023 to 19% in 2024. This decline is attributed to factors like economic slowdown, talent shortages, and the geopolitical instability affecting the region. Now, while the Middle East and Africa, or the MEA region, currently holds a small share of around 3% of the total new center setups, we expect this to rise in the second half of 2024. Several service providers are exploring these untapped markets, seeing potential for diversification in the region. Lastly, the Americas have maintained a constant. Yes. Lastly, the Americas have maintained. Yeah. Yes, Parul, please.
We received one question from Centrica, and it's very timely on this piece that you're talking about. So thought of sharing this here itself. So one of the questions we've received is, what's the longevity of arbitrage in the more traditional offshore locations? And we're talking about offshore locations like India, Philippines, and you can already see that the center setups continue to increase. The reason they're also increasing is because when we did a fair bit of analysis on our side in terms of crystal ball gazing and looking at how does the arbitrage look, considering the FX movements, the high wage inflation, interestingly, despite all of those movements, the arbitrage proposition continues to stand strong, even if we were to extend our forecast till about 2050. So the story that continues to grow on the back of offshoring, especially for locations, particularly in the APAC markets, continues to stand strong. And with that, also a reminder to everybody dialing in, if there are more questions from any of you, feel free to drop those in the chat. We'll be happy to take them on. Back to you, Harshit.
Thanks, Parul. So I was just saying that lastly, the Americas have maintained a consistent share across the years, with Mexico leading in terms of the center setups. Not only are we seeing growth in Mexico City, but also in tier 2 cities like Guadalajara, Monterrey, and Querétaro. Additionally, Colombia is becoming a popular location due to its operational costs and growing English proficiency across the country, especially for BPS delivery. Now, it's interesting to note that while we have discussed overall trends, there are distinct variations when we look at the data from a service provider perspective versus that of a GIC or GCC. While service providers contribute to around 1/4 of the total center setups in the first half of 2023, this figure has dropped to less than 1/6 in just 1 year, due to a 41% decline in the number of center setups between H1 2023 and H1 2024. Now, this sharp fall is tied directly to the stagnant revenue among providers. As shown in the chart on the right, the revenue growth across both global majors and offshore heritage providers, including IPPs or India pure play providers, has been minimal. In fact, many of these leading providers have reported either no growth or even declines in revenue during the first 2 quarters of 2024. With muted top-line growth and increasing margin pressures, service providers are struggling to maintain their operating margins. This has led to a decline in headcount, with several leading providers seeing workforce reduction over the past 18 months as they focus heavily on operational efficiency. In fact, some of these providers are actually using this industry slowdown as an opportunity to correct overhiring from the high growth period post the pandemic during 2021 and 2022. And much of this slowdown can be attributed to the low propensity for capital expenditure in today's uncertain economic climate. Additionally, it's a reflection of the optimization of delivery portfolios, which were rapidly scaled during the boom years. This suggests a clear warning for the outsourcing providers and to adjust to these market conditions. But however, on the other hand, there has been a notable increase in the adoption of the GCC model in the global service industry, which has surged over the past 2 to 3 years. Now, despite the challenging macroeconomic environment last year, we observed a 17% growth in the number of GCC center setups. Additionally, the workforce employed within GCCs, particularly in offshore and nearshore markets, grew around 4 to 6%, bringing the total number of employees in this industry to over 2.6 million. This robust growth is driven by several key factors. First, being that enterprises are showing a high propensity to retain core services and functions in-house to maintain stronger control over company culture and deepen customer intimacy. And even GCCs have evolved their value proposition and are moving from a cost-first to a value-first mindset. They are no longer seen as merely as cost-saving centers, but as key players in driving global mandates, including enterprise-wide digital transformation initiatives and more. Now, while it's no surprise that the GCC market is running on steroids, what's particularly interesting is that more than half of the new center setups have come from first-time adopters of the GCC model. This surge is driven by multiple reasons. First, if is the availability of high-skilled talent at scale, not only for entry-level roles, but also for experienced leadership positions. Second is the low barriers to entry into the GCC model, thanks to improvement in the infrastructure and a growing global delivery ecosystem that makes setting up GCCs even easier than before. And finally, the sustained cost arbitrage in offshore and nearshore locations, which help in enterprising managing rising cost pressures. Now, looking ahead to 2024, we anticipate an even stronger growth across all industries, with BFSI and the technology sector leading this charge. These industries are increasingly embracing technology-driven approaches with the support of GCCs. When it comes to key service lines of functions, we are seeing high growth in areas such as IT ADM or IT application development and maintenance, and judgment-intensive BPS functions, including marketing, supply chain, S2P, and procurement processes. Now, while GCCs continue to be leveraged for IT infrastructure and transactional BPS services, in contrast, these areas are experiencing slower growth. So overall, it seems like GCCs will continue to be the flavor of the season for the global services industry moving forward, with tremendous potential for expansion and innovation. Now it's time for our first poll of the session. This poll is for both enterprises and service providers, and the question is, which of the following tactics is your organization adopting to reduce the operating costs, and now specifically for the service providers to optimize your margins? We have 5 options. First is implementing next generation solutions such as the likes of GenAI. Second is increasing offshoring and nearshoring to lower cost locations such as India. Third is rebalancing delivery port pyramids for most efficient operations. Fourth is leveraging tier 2 or tier 3 locations for service delivery, and this can be across any region. And the last is looking at outsourcing contracts and deals to identify areas of improvement and optimization. Now, as we are waiting for the attendees to fill in their responses, I recall one of the leading professional services firms expanded their presence to tier 2 and tier 3 locations, including setting up its new technology development center in Coimbatore and another in Bhubaneswar with plans to hire 1,000 FTs in the last 2 years in that center. This firm has started setting up centers across tier 2 or tier 3 cities to tap into large talent base, provide more flexibility to the employees, and to tackle soaring attrition levels. As the firm plans to double its India headcount over the next 3 years, tapping into tier 2, tier 3 cities will be helpful for the company to achieve this target. Now, having said that, it would be interesting to understand how the results of this poll align with our findings based on our research. And for that, I would like to invite you, Ricky, to share your expertise on the topic.
Thanks, Harshit. I think very relevant in terms of what we're going to talk about today, and not very surprising to see the results, right? Increasing offshoring, nearshoring, as well as sort of implementing using some of these next gen levers. Very timely. In fact, we have our own point of view on this in terms of how some of these levers contribute to margin improvement going forward. But yeah, I think it resonates very strongly in terms of what our own research also suggests on this topic. So thank you so much. Parul, if we move on and let's talk a bit more about, I think, thanks, Harshit, for setting that context in terms of what's happening in the market, in terms of center setups and the overall market trends. We're going to talk a bit more specific about price and cost trends, right? Because that's a very sort of a very hot topic right now. In fact, we recently had a conference in Dallas, and cost was one topic which everyone resonated about. And all enterprises this year are all about maintaining and optimizing costs. So let's talk a bit more about that. And I think given that it's a pressing topic for enterprises, it becomes an equally pressing topic for service providers, right? How do they optimize and how do they run their deals at a more effective cost levels? So what we've tried to do on the subsequent pages is, so for example, let's take offshore. So Parul, if we just moved, yeah. So if we're going to talk a bit more about what are the different levers or factors which have contributed to some of these sort of these cost pressures. And of course, I think the sort of the weakening demand is of course sort of the underlying factor to all of this. But I think it's intensified by a few factors. For instance, there's been increasing competition in some of these some of these markets, and we'll talk a bit more about that. We'll talk about tier two, mid-tier providers, big four providers increasingly becoming relevant. We're also talking about rising talent competitive intensity in tier one hubs, especially the Bangalore's and Delhi NCRs, where we're seeing increasing talent costs to hire and retain people. Inflation definitely, I think, it has started to cool down compared to the last year, but again, still remains a bit high, and that's why while we saw some positive movements on the FX on the rate reserve cut by the FX by the Fed Bank in US last few weeks, but the same is not yet translated in the UK and other markets, so we're waiting for that as well. And I think as the demand situation still remains very peculiar, very precarious. Um, and I think the final point is really the increased expectations from buyers. I think increasingly buyers are sort of expecting very quick ROI on their very strong ROI articulation on their investments, right? So every penny that is being invested or asked to being invest, they're being scrutinized in terms of what is the ROI associated with it, what is the payback period, right? So there's a lot of scrutiny on that. I think increasingly one thing which also came out in our recent conversations with enterprises is generally, in spite of having worked with some of these providers over many years, they're seeing having a lot of issues when it comes to quality. So there was a lot of conversation on XLAs around, in spite of having worked with the same provider, we're not getting any innovation in our contracts, and that's actually causing some of them to go look for alternate vendors as well. And that also is manifesting is, if you look at the sort of the word cloud that we've put in here, these are some of the key themes that are resonating across a lot of contracts, especially given that the market is very intensive, right? Very competitive right now. Almost every deal now talks about how are you going to manage my coal and FX contingencies? Are you going to waive off my transition fee? Can you waive off my termination fee? Can you bring in some skin in the game? Can you put in some outcome based or gain share sort of pricing model into that? Can I have some early payment discounts, right? So those are themes, those are conversations that we are seeing in almost every new deal renewal or new deals that are getting signed in the market. And that has an impact in terms of the margins that service providers are potentially able to make out of these deals. If we move on and let's talk about a bit more specific analysis on specific markets. So if we look at this chart over here, we've looked at the cost and pricing trends for specific IT and BPO functions. Uh, I think probably if you look at the first column, which says cost movement in the past 9 months, you probably notice that the cost has gone up by about 2.5 to 3.5% consistently, irrespective of what function we're talking about. And as much as providers would have liked to have, of course, price movements have not kept pace with that, which of course is leading to pressure on margins. The other two factors that I would say is intensifying competition, which I spoke about, weakening demand environment, and a growing expectation from buyers. They're likely to further reduce pricing for offshore locations and across different functions, despite the expected rise in operating costs. Of course, I think the other thing which have sort of excavated is that the easing of attrition across providers has actually improved the demand supply gap between in a lot of markets. And now providers are increasingly focusing on increasing offshore resource utilization and finding ways to do more with less. So I think if you look at a forecast as well for the next 12 months, costs will continue to remain high for at least for the voice PPS and non-voice PPS functions, and for IT ADM and infra, we're expecting them to stabilize or kind of remain flat. But yeah, I think unless providers find a way to actually optimize their costs further or find a way to increase their top line or sort of grow the increase their pricing, margin is going to remain under pressure. Parul, if we move on and have a sort of a similar view for nearshore, I think not very different from what we spoke about, right? The story actually gets worse at nearshore because costs continue to remain high in some of these popular nearshore locations like Mexico and Eastern Europe, and price increases over here have been slightly better than offshore, but they're still very flattish and probably under 2% in most of the regions, and in fact have dipped into negative territory for voice PPS services. So voice PPS is under pressure over here as well. And we anticipate that the operating costs are going to remain high in the nearshore locations because of high inflation, currency appreciation, just typical problems that you see at some of these nearshore locations. And price movement, unfortunately, is going to remain muted from a provider perspective due to macroeconomic and geopolitical constraints. So I think, but increasingly, the good part is that we are definitely seeing growing demand for next gen resources, next gen services, and in from being delivered from nearshore, and increased propensity to actually get them delivered from there. And however, I can't say the same about talent, because talent for next gen skills in this region is rather limited. It's growing, but it's still rather limited. So you can't really hire talent at scale, which you probably get access to in a location like India. Talking specifically, I think Mexico as a geo has sort of bucked the trend in the region and shown an average increase in prices, although it has been remained muted because of increase in inflation. So that's something positive in Mexico. And if we look at a similar story for onshore, I think in North America, we've sort of seen increase instances of vendor consolidation, RFPs being released, enterprises looking to rein in their IT spends, providers also very aggressive in such deals to obviously retain some of this business and to be top of mind. For instance, in Europe, I think Belgium as a geo has been an outlier because salary hikes have been significantly higher, because I think it's government mandated salary hikes, which actually put pressure on providers to actually increase prices, even though the trend has been very flattish. And over here as well, I think in onshore as well, voice PPS is amongst the hardest hit functions across US tier two locations because of increasing sort of pricing pressure, because of macroeconomic situation, again, slowing demand and fairly aggressive discounting by providers, which is a trend which is probably likely to continue in the next 6 to 12 months as well. So, all in all, I think as I mentioned, cost continues to grow, but prices obviously are not growing in the same proportion. And I'm going to talk about one reason why this is happening. Prices are not growing, I think, is also because of the intensified competition. So we do this key issues survey every year, and we talk to our enterprise clients in terms of what are your key business objectives, your priorities for the next year. We did this year as well, and nearly, if as part of this survey, nearly 67% of the respondents mentioned that they're going to look at, if you look at the blue bars and the gray bar, 67% of the respondents mentioned that they're going to look at rebalancing their portfolio, either consolidated or kind of look at rebalancing work across different providers, maybe not bring in new providers, but rebalance it within their existing providers. So that's where some of these sort of consulting heritage providers, mid-tier providers, for instance, in a lot of client environments that we are aware of, mid-tier providers have been there. They kind of in the portfolio doing some bits and pieces, some very small piece of work, but they're now actually able to increase their wallet share. We're also seeing a lot of legacy telco firms intensifying or growing into the managed services business, consulting heritage firms, right? And yeah, everybody who's been in the industry probably would have heard of Big Fours significantly expanding their capacity and growth in the sort of setting up large centers in offshore locations. OEMs, VARs aggressively getting into the managed services space. And of course, I think as we mentioned earlier, insourcing is a big theme right now as well. So increasingly, a lot of organizations are looking at GCCs or shared service setups at offshore locations. If I talk about one theme, and this is increasingly a question we get, right? Why are these mid-tier providers able to buck the trend? For instance, if you look at the overall, most of the larger providers, they're growing at probably 2 to 3%. And that too, the growth has been there only the last couple of quarters. But then the mid-tier providers have typically grown at double digits, or at least close to that, or slightly lesser than that. I think what's really working for them, The fact that they're not tier one and they're very flexible when it comes to creating client solutions and the commercial approach, typically clients feel they're better suited to my need. Plus they're very focused. They will not typically bid for 100 million plus deals, right? They're very focused. They know what their sweet spot is, where their strengths lie, and they bid for that. However, increasingly we're also seeing them becoming very relevant in sort of the 30 to 60 million dollar deal sizes as well. And there's a perception that mid-tier providers are very competitive, and that is partly true because they're very competitive in their local markets. If I talk about, there's a specific certain providers who are LATAM based, they're very competitive in the LATAM markets. But when it comes to global deals, they typically may tend to get expensive as well. So it's not one size fits all. Yeah. Um, Parul, if you want to talk a bit more about what some of these other factors which are causing this increased intensity in the market.
Absolutely. Yeah. So what we did is we analyzed leading 7 locations offshore, near shore to understand what the talent situation is going on in them. So starting with APAC, most of the tier one locations that, the giants, the offshoring giants like India, Philippines, to some extent, even now upcoming Malaysia, we're seeing fair bit of saturation coming in. So the little men that you see with arrows around kind of talk about attrition, and the one with the circles around is talking about the wage inflation or the rise in the cost that we see. So while the attrition situation has kind of cooled down relative to last year at a global scale, it still continues to be quite high. And then if you talk about the number of center setups that have happened alone in India, it's about almost about 100 new center setups just in 2024. So we're seeing increased traction, more investment coming here. That's also causing a lot of saturation here. In the Europe market as well, Central Eastern European markets kind of getting sluggish growth. So attrition and wage inflation are below 2023 levels. So that's why we see them slightly in the yellow greenish place. But they're continuing to kind of facing, companies are kind of saturating in terms of how much they can. They're hitting the ceiling in terms of how much they can expand beyond what they've already kind of scaled in. Mexico is slowly becoming the go-to nearshore location for technology services, with more competition also coming in. I think almost close to 7 new delivery center setups have happened within the year 2024. Across all these locations, costs have meaningfully risen up in the last 3 years. In fact, few clients have also mentioned a plateau in productivity as they struggle with higher operational costs and talent attrition. Now, not everything is gloom and doom. While tier one cities are kind of facing this situation, there's a silver lining in the emergence of tier two, three locations. And the benefits not only include 10, 12, 15% kind of lower cost, but also access to untapped talent markets, lower attrition rates, and in some cases, early mover advantages. On the enterprise side, so all the locations that you see here, the ones highlighted in orange basically indicate where you've seen 5 or more new center setups happening in the recent years. So they kind of call for new attention. Across all these locations, we are seeing even big logos, Fortune 500 companies kind of establishing presence in tier 2, 3 cities. So for instance, Amazon opened their center in Yash, Kraft Heinz opened one in Ahmedabad. We're seeing Mars coming in Chongqing, China. Mix of locations, different reasons, somebody kind of leveraging these locations more for kind of getting cost advantages, some leveraging these locations for leveraging, for the benefit of kind of getting the local language resources at lower cost. The reasons may differ, but there is a fair amount of strong headwinds kind of causing companies to consider tier 2, 3 locations in their mix. Now, I know we're overdosing. My team has reminded me we're overdosing the attendees with fair bit of insight. So here we come, pairing gifts. Today's offer includes complimentary access to any of our 3 leading reports. To request the reports, simple platform, you need to indicate your selection in the post-webinar survey, the message that's being posted in the chat, or you can access the details via the follow-up emails as well. Continuing with the tier 2, 3 narrative on the enterprise side, on the provider side as well, we've started to see providers kind of leveraging a hybrid mix of both tier 1 and tier 2, 3 locations in their deals to kind of win those pieces. So one of the examples we have, this is a real life example, anonymized obviously for NDA purposes. One of the organizations which bid, one of the providers which bid for a European FS organization, while kind of compared almost at par with other competitors on parameters such as the delivery pyramid, shoring mix, productivity, the FT size, etc. However, when they were creatively able to kind of put in their strategic use of a tier 2 Indian city, Kochi, that led to a hyper competitive pricing. As we established, we talked about earlier, there's a high focus on cost optimization. This kind of nuance and adding in this location landed them in a favorable slot when it came to their overall selection criteria. If we look at locations, the tier ones, we're talking about Bangalore, Hyderabad, Chennai, Delhi, NCR, and look at tier two locations like Coimbatore, Ahmedabad, Kochi, Jaipur, at a pricing on an index level, they do offer closer to 5 to 7% kind of differences. In fact, at a cost level, these differences tend to get a bit higher. Obviously, coming into baking in margins, they all get rounded up to this piece. Now, while next another factor kind of driving a lot of this decision piece is around the volatility of foreign exchange movements, foreign exchange rates, and inflation. Now, for most of the global services delivery operations, FX fluctuations lead to unpredictable financial outcomes. Now, to protect against this risk, we are now seeing companies not only actively using hedging strategies, but also building currency risk inflation forecast into their financial models and kind of monitoring them way more frequently to avoid unexpected cost spikes. The right side, which talks about the CPI inflation, inflation is on the rise globally, and in fact, many regions have now started, down from the time when they've reported double-digit increases, but still the cost of talent is increasing. The wage inflation is outpacing the revenue growth and the margins pieces that companies are trying to make. So overall, making it very hard to maintain profitability, particularly in tier one cities where skilled labor also demands a premium. So everything from space rent to utilities is becoming expensive. This kind of making cost optimization a top priority. Now, to talk more about the other factors, calling on Manish to share his expertise, please.
Sure, thanks, Parul. So, as the team has already highlighted how the industry is under pressure in terms of demand, in terms of the other elements, macroeconomic factors, and the ongoing, we understand the geopolitical and economic challenges. We understand traditionally enterprises and service providers have taken 5 kind of constructs to manage the FX. So, one definitely being the no FX used, and then an annual adjustment basis, the change which has happened in the currency movement. And then we have also seen contracts wherein they were signed in the local currency and later on converted into the USD at the time of billing, which ultimately passed on the risk to the buyer instead, right? And then there have also been cases wherein we have seen a shared kind of risk, wherein both the parties take equal kind of risk and they hedge it accordingly. And then there have been instances of FX-linked renegotiations if the FX movement goes beyond a particular dead band. Now, considering it's a buyer's market and service providers under pressure, we are observing that in certain cases, and the service providers are agreeing to kind of sign the contracts in local currency with no FX adjustment clauses related. On the other hand, we are also seeing innovative constructs proposed by service providers in discussion with the enterprises, wherein they kind of bundle the impact of COLA and FX. So an interesting example that we saw recently was for India location, wherein the budgeted proposed fee budgeted for year on year adjustment in the rates was about 2%, and the deadband was about 0.5% on each of the sides. And if the actual movement goes beyond this particular deadband, then there was a mutual clause for adjustment of the fee. Now, this has been a particular trend, again, driven by the intense competition, the subdued growth in the top line. And again, if we talk about mature geographies like Poland, Mexico, they have seen, if we talk about the last 18 months, they have seen significant appreciation in the currency, leading to a rise in the cost for service providers, in addition to a pressure on the price, which ultimately erodes the margins. Now, talking about COLA, wherein in 2024, Parul, if you can move to the next slide. Wherein, like in 2024, while inflation has eased down in most of the geographies under consideration, traditionally we have observed around 3 approaches to manage COLA. One is year-on-year flat COLA and increase in your FT base rates. Then there's a variable COLA, which is linked to your multiple indexes. It could be CPI, WPI, or AON. And then there is also cap and collar approach that we have observed. But recently in the deals signed in the last 9 months, we have seen service providers and enterprises pushing for a no COLA based deals. Herein, so it's basically passing on the risk of the inflation and service providers absorbing the increased cost, which is kind of linking back to the cost trend that Ricky highlighted previously. And in some instances, especially in the APEC market, we see that wherein the cola increase, the inflation is mostly on the higher end as compared to your North American geography, wherein it is kind of linked to an external benchmark, which is again kind of CPI or WPI. Now, herein we have recently observed an interesting example wherein we're advising a service provider, and how the service provider done financial engineering is that they incorporated a COLA mechanism. And while the enterprise agreed for the year-on-year COLA increase, service provider also promised additional productivity benefits, wherein the overall TCV would reduce in parallel to application of COLA, right? So now, double clicking on the vendor consolidation exercises, again, stemming across from the talent supply crunch, which was in 2021, 2022, wherein your enterprises kind of diversified their portfolio to better manage the risk. And then later on realized that, okay, some of the enterprises might have over diversified, leading to an increase in service provider in the consolidation exercises. So herein we have observed that while the overall number of deals from 2022 to 2023 have increased, and so have the vendor consolidation exercises, wherein enterprises are also choosing to give to give both the BPO and the ITMS scope to the same vendor. Now, it is primarily driven by the commercial and the operational benefits. The commercial benefits are synergies in terms of your governance and the PMO cost, the investment the service provider brings into the table, the tools cost, and further economies of scale in terms of your volume discounts. Operational benefits we also observe in terms of greater accountability being on the service provider, in terms of the collaboration between the business process and the IT teams, then improve outcomes. The stakeholder satisfaction seems to improve in these cases, and again, a further reduction in escalations. Again, when we talk about vendor consolidation exercises, we see them mostly prevalent in the mature geographies like North America and Europe, and again, done by mature buyers who have kind of outsourced their operations, both IT and BPO, across a couple of years, and have understood the market as of now. Right. Moving on, adding on to what Harshit mentioned earlier in terms of the number of increase in number of setups of GBSs in India. Again, we all understand the reasons, like when enterprises desire more control, they want better quality, keeping the cost in hand, and then develop and maintain the culture that goes in line with the overall operating environment globally. Now, we have seen enterprises taking support of service providers primarily via three models, which is via BOT, build, operate, transfer, assisted captive, and JV. Again, each having its own pros and cons. And out of these three mechanisms, we see assisted captive to be the largest, and we have seen JV to be declining a little. And herein, like in an interesting example in terms of the coming out from our Engage event. So most of the enterprises are already considering insourcing, or they are already in talks with the service providers in taking their support in how to build a captive, especially in India location. Now, in terms of the number of captives that we observe, wherein service providers are supporting enterprises, most of them, about 60 to 70% come from the TMT manufacturing and BFSI verticals, wherein enterprises, again, it's a factor of volumes and the security and the privacy controls, plus the capability that service provider brings to the table. Now, lastly, coming on to the buyer expectations, as Ricky mentioned, a factor of decreasing price and increasing cost pressure. Now here, talking about the first factor, which is innovation. So what we are seeing recently in deals is when enterprises are kind of evaluating the service providers in competitive bids, they kind of evaluate the solution in terms of how clearly the provider has articulated the funding mechanism for the innovation. And in addition to the innovation fund, how would the innovation fund be used? What are the various mechanisms and the channels? And is service provider able to demonstrate the use case, especially coming out of the innovation fund, that will be driving such innovations? The second factor is outcome-based construct. This we fairly see in the case of renewals, wherein service providers proactively reach out to the enterprises and offer a shift from the traditional input-based to output-based, and further to outcome-based constructs, wherein some kind of gain sharing happens, and wherein the service provider will be able to have skin in the game and drive business outcomes for the enterprise, and not just an increment or improvement in the SLAs. Now, Again, this is mostly observed in cases of renewals, wherein service providers proactively try to build relationships and ensure that they avoid a competitive bid scenario. Then in recent times, we have seen enterprises being more aggressive in terms of negotiation around the TNCs. And again, recently we saw an example wherein a service provider, despite being cost competitive, lost a deal because it was kind of inflexible to adhere to the request of the enterprise in being in incorporating some of the TNCs basis the requirements. Then when we talk about the upfront savings, especially over the 9 months, we have seen that enterprises are slightly getting impatient when it comes to Gen AI, because what we have observed is service providers give generic references related to Gen AI in the solutions. However, a clear articulation in terms of how it will be applicable, what would be the benefits to the enterprise, they are not kind of incorporated. Additionally, when we talk about the pricing for Gen AI related items, it is rarely observed and is typically bundled within the overall pricing of the solution. And then it brings about like, why is this happening? So in a recent survey that we did, we kind of observed that around 85% of the overall Gen AI related POCs, they have failed to reach the production stage. So now enterprises expect service providers to clearly articulate the benefits that they would be driving from such engagements or such initiatives. Right? This brings us to a poll in terms of what percent, and especially for service providers. So what percentage of Gen AI-led productivity gains are you kind of proposing in the deals? Is it like less than 10%, 10 to 19%, 20 to 29, and 30 or more? Now, another interesting conversation while you put in your vote, another interesting conversation that we generally have with service providers is regarding like they can, but should they? Now, therein we typically suggest them that, okay, to assess particular transformation initiative or initiatives from 4 angles. One, are the benefits only incremental to what was initially being proposed by using other kind of tools, even before Gen AI? And then what is the kind of ROI for the enterprise? Because enterprises generally expect an ROI of 3.5 to 4x, especially for large deals, depending upon the context and the in-scope items. And then especially wherein we have seen this such AI, such transformation initiatives failing, is that service providers fail to understand that, okay, there would be certain investments required from the enterprises as well, but are they ready to do it? Do they have the capacity to do it? More again, from a resource angle and from a cost angle. And then again, while most of these initiatives may look practical, may look theoretical, but how do the benefits outweigh the costs here? Now with that, we'll just close the poll in about 5, 4, 3, 2, 1. Yeah, interesting. Ricky, any thoughts of what you see in the market versus the result that we have gotten here?
You may be sharing insights when you're on mute.
Our own results are also actually very similar to what we've observed there. About 70% of the respondents suggesting it between under 19%, and that's what even we suggest in most functions, anywhere between an 8 to 15% of incremental productivity gains over the sort of the standard automation, traditional continuous improvement that we have. But yeah, I think this is largely resonating with what we also observe in our own research and analysis.
Absolutely.
Perfect. Thank you so much, Manish. With that, we now move on to the last piece where we want to talk about what are the key takeaways and recommendations from our side for enterprises and providers. We'll start with the enterprise audience. So what we're trying to do is, across all the pieces that we've so far analyzed, the common theme is the pressure or the piece around optimizing cost. In order to optimize costs, we've kind of looked at all the possible levers and prioritized the top 5. What they mean is, number one, kind of looking at your portfolio of locations, re-optimizing them, selecting regions that offer the best mix of talent, cost efficiency, currency stability, and the skills that are required. So look at locations portfolio, how you can think about optimizing your costs here. The second piece is around the leveraging of kind of growing your appetite, risk appetite, and stepping foot into tier 2, 3 locations that can offer you that additional, 10%, 8% savings on cost, and also give you untapped kind of access to that untapped talent pool. The third piece is around vendor management, which is a ripe area for optimization. We're already seeing at least out of the 10 kind of Fortune 500 clients I've spoken to in the last 3 months, 6 out of 10 are kind of undertaking active vendor rebalancing. They're adjusting the scope of work, redistributing it among fewer, more strategic partners in order to extract greater value from their vendor relationships, at the same time maintaining that flexibility. So we're seeing fair amount of vendor rebalancing work happening. The fourth piece is around, can you right size the delivery model in order to kind of allow for greater efficiency, reduce your overheads, improve the service performance? So this not only includes, say, pieces around use of low code, no code platforms to perform some of the repetitive or low skill tasks, but also how can you infuse or kind of think about the impact of technology to kind of minimize the labor required and optimize your overall pyramids. And finally, the last piece is around companies kind of looking to incorporate these clauses around to enable kind of periodic renegotiations based on the market conditions. We've seen this approach to help companies because they don't get locked up into unfavorable terms, especially with inflation, FX fluctuations, which make longer term contracts a bit riskier. Now, for the provider side, Ricky, I know you interact with more providers than I do. What are your
Yeah.
recommendations that are?
Sure, thanks, Parul. I think just going back to the previous slide, one thing probably want to add is I think the benchmarking clause or sort of reusing benchmarking as a tactical tool may seem very straightforward, it may seem very intuitive, but the number of legacy contracts that we've actually come across over the last couple of years. And when I'm talking of legacy contracts, these are contracts which were signed, maybe the first time they were signed was about 12, 15 years ago. And they've been renewed every 3 or 4 years without significant changes into it because the buyers were comfortable, the clients were comfortable, the providers were comfortable. But now when we actually started to look at those 12, 15-year-old contracts, the amount of value leakage that we identified in those was actually a kind of eyebrow raising. I mean, we were shocked to see there were so many inefficiencies in those contracts. And obviously, from a provider perspective, it's not conducive for them to sort of bring these out because ultimately it does impact their margin profile in a negative way sometimes. So, but yeah, as I said, it may seem very intuitive, but there is a lot of value that clients tend to leave in that. Yeah, I think moving on to as Parul was referring to. So in terms of, and we want to talk a bit more about how do you differentiate winning pursuits from the ones that don't win, right? And one thing that we want to talk a bit about at a high level in terms of, okay, so pricing and contracting, solution design and delivery model, these are probably the two most important parameters of any sort of winning pursuit. When we talk about pricing and contracting, we just don't mean sort of being the lowest price vendor or the lowest cost vendor in the room, but also sort of showcasing some flexibility, showcasing some skin in the game, trying to show that value in terms of moving from just a time and material or a rate card based model to having more skin in the game or output based sort of outcome based pricing models, right? Having a very strong ROI articulation story. How quickly can I realize my investments? So that, and then finally followed in terms of the how closely is the solution that you're proposing aligned to what I really need? I think again, this seems so straightforward and seems very logical to do, but then the amount of times when providers get eliminated only because of that, because at times they're just not listening to what the client really needs, right? They're trying to portray their version of the world, or they're trying to portray their version of they're trying to sell their version of the target operating model, or but trying to force fit a particular solution into a requirement. I think again, that shouldn't happen as many times. Similarly, I think talking about things like strategic levers, right? Transformation. Again, these are again great story points or important differentiators. For instance, there are things like, and when I talk about strategic levers, it often you cannot have a provider fill a document to say, okay, these how are you strategically aligned to what I really need. It actually is perception that the client that the provider executives often give, right? For things such as how quickly are they able to respond to a particular request that I have? How quickly are they able to share more information? How responsive are they to my needs? These are things which are very subtle, but that gives a very strong understanding of what the culture is, what the vibe that the provider executives are giving, right? So those are things that providers should really be careful about when they are looking at pre-bidding. And if I finally talk about, I think this is probably the most important talk conversation point right now in a lot of service provider executives. If we move on to the next page, Parul, And increasingly, we're seeing a lot of providers asking and talking about this, given that the top line growth has been very hard to come by the last few quarters. Almost providers are focusing on growing or improving their bottom lines, right? So let's just talk about what are some of those levers that we see increasingly providers use. And these are not just theoretical levers, because we ourselves have been involved in a couple of engagements helping our clients drive savings on their bottom line. For instance, simply increasing workforce from in tier 2 and tier 3 cities, especially for providers who are already there in India, who are already there in tier 1 cities, increasing workforce in tier 2, tier 3 cities can actually sort of add a significant improvement to your bottom line. Similarly, for providers who are not in India, or maybe at sort of at a very small scale, just growing that presence in India can again lead to immediate cost savings and better access to talent, of course. Uh, for many companies, I think again, pyramid rationalization, right, is a very major source of cost saving. And of course, I think we spoke about this earlier as well. Productivity gains, right, leveraging advanced AI, Gen AI related levers to actually help you improve your bottom line further. And then finally, I think this is also often understated. Corporate and enablement functions that contributes to nearly 30 to 50 basis point reduction in your overall improvement in margins. That is basically the way providers are doing this is by reducing the size of the delivery enablement teams and pushing more of this delivery enablement work to offshore or low cost locations. Again, that's a very obvious thing, but not many of them are doing it right now. And then I think, of course, the other levers include things such as utilization and bench strength rationalization, I think, which already a lot of providers are pursuing in the last 12 to 18 months that we've seen. So yeah, I think that would be our final recommendation and final inputs in terms of what we are seeing in the market and what we are observing. So with that, we'll open the floor for any questions. We've seen received a ton of questions. Let's just start with a question on locations. Harshit, this one is for you. So what barriers to entry in low cost markets are vendors experiencing as they pursue additional markets? And specifically, what are you seeing with entry into new regions, specifically to the BPO market, to the BPO service providers?
Sure, Ricky. So when we talk about additional low-cost markets to explore, locations in Africa are at the talk of the town. And I'll take the example of Kenya. And when we talk about some of the operating risks in that location, there has been reports of protests over the last recent finance bill, which was introduced by the government. Also, corruption is sort of a widespread issue, which is affecting the business environment and judicial processes in the region. And while the country has built significant process and technology adoption and digital infrastructure, it is relatively underdeveloped if we compare it to the major locations. Another nascent but growing market I would talk about is Chile in the Latin region, where the overall business environment is moderately favorable. The country still faces potential headwinds due to the government's reform agenda, or which includes tightening regulations and increased state interventions, leading to higher cost and posing medium to long-term risk for business and investments. So different market comes with their own set of risks, be it infrastructure related, geopolitical, macroeconomic, due to regulations and ease of doing business. And those risks are typically higher in the nascent markets in general. However, firms need to be cognizant of these risks and judge a market based on how and if these risks impact the global service delivery from that location or not. Hope that answers the question.
Yeah, got it. Thanks for that, Harshit. That's really helpful and elaborate. Parul, I think probably you're best suited to take this, and this comes from Michelle. What's the longevity of arbitrage in the more traditional offshore locations?
Yeah, I think, Ricky, this question keeps kind of coming, circling back in different shapes and formats. But yes, we've done this analysis, and we do try to kind of, being the analyst's mindset that we have, so we try to run this and validate this with all the numbers. When we did this analysis specifically, say for leading locations like India, Philippines, Poland, Mexico, Costa Rica, majority of them, their arbitrage kind of proposition continues to stand meaningful, continues to stand tall. We will kind of talk about the hurdle rate, which is anywhere between 30 to 75%. That kind of continues despite all the currency exchange and inflation movements, kind of each offsetting the other. And hence, there seem to be, the bullish sentiment on offshoring locations continues to remain. The arbitrage continues to stand tall.
Yeah, and I think a related question, probably again from Jamie. is in terms of what are specific challenges in the India market, specifically which are more relevant in 2024 that you should watch out for and plan for going forward?
For the Indian market, I think while the attrition situation has kind of cooled down, relatively cooled down, I don't think I want to jump the gun and say it has cooled down. It's relatively lower than what we saw in the last 2 years. However, attracting the right set of talent in the time frame that you are looking at. So the time to hire for the right talent, that's continuing to be a big pain point. We are seeing a lot of the leading employers in the market focusing on what my employee value proposition should be. We also did a recent study around GPS and tech value proposition, who's the leading kind of employers in the market, that also talking about what are they doing to maintain that attractiveness in the market. But yes, a lot of focus is kind of going on how can you make your brand stand out so that you attract the right set of talent in the first place.
Got it. There's a question around price differential between GICs serving global contracts, and then is there a price difference between them versus, let's say, if you were to directly contract through the headquarters? So a very interesting question. I think we've been doing some research around this topic, and our analysis suggests that if you were to contract it through your service, through your headquarters, let's say the index is 100, versus if you were to do the same through your GCC or GBS center, you would probably get it at least a 10 to 15% cost arbitrage. I think there's no the one way to sort of explain this is just better pricing and more cost competitiveness. I think that's just one behavior that we're starting to see, obviously. And if you want to go further, one step further, and if you say, oh, I want to contract, I just don't want to contract from my GBS or my GCC, but also want to sort of contract in INR in local currency, that maybe gives you another 5 to 10% cost arbitrage, because now we're actually removing the FX risk which the provider earlier had. So that actually gives you even a better deal than that. So if you're looking to contract through your GCC, feel free to reach out and we can talk about it. One more question, I think, Parul, this again goes back to our conversation around Mexico and LATAM. So how soft landing vendors from India are sort of rushing to offer their services in Mexico and LATAM, given the boom in sort of the nearshoring in North America? And this comes from Jacob.
We are seeing, and that's a very relevant question. I think we are seeing fair bit of Indian heritage providers kind of expanding or maximizing their presence in the nearshore locations, particularly from a tech standpoint in Mexico and to some extent in Costa Rica. Although this is not kind of a new thing that we are seeing in terms of, say, a TCS setting up in Mexico, but we are seeing more nuanced pieces, especially when buyers are kind of asking for, say, the same kind of time zone or cultural advantages. So there is fair amount of arbitrage proposition that continues to stand relative to US. But beyond that, more importantly, is the piece around the access to talent, the piece around the kind of skills that are available under the time frame that they're looking at. So all of those nuances with maturity of some of these locations are, such as Mexico City, Guadalajara, kind of evolving in the last 5-6 years. That's kind of helping to position these locations in a much more favorable light. I realize we're at the top of the hour.
Yeah.
I want to thank everyone for joining in. We do encourage you to take a moment to go through our blog section, reports portal for related content, and navigate the homepage of our website. Lots of information. Thank you so much for joining in.